Hi everyone, welcome to AO Accounting Academy. Today I'll be discussing double entry bookkeeping. Double entry bookkeeping is a system of accounting that records transactions on two different sites. It means that every time you have a transaction, accounting transaction, it is expected that that transaction will have two different legs. It might be asset account, it might be a liability account, it might be income, it might be expenditure account. So what we're saying is that every single transaction that you post at every point in time must have double entry. That is the entry on one leg and the entry on the other leg. So for us to be able to explain double entry accounting properly, I think we need to look at the accounting equation first. The accounting equation defines a relationship between what comprises an account. Okay, for instance, a business owner. Let's take an example of a business owner that just started a business. That business owner is expected that that person will bring in cash, maybe in the form of cash itself, or maybe in the form of assets like maybe motor vehicle to start the business, maybe to do running around for the business, or something in the form of a building, maybe building, bringing a building as a structure for the business. So at that point in time, the owner of the business will have been said to have brought in capital to the business. So, but that capital, on the other hand, looking at the double entry principle, that capital, if it's cash, then that cash is an asset on itself, which is the asset that is you're seeing on this side. If it's motor vehicle, it's also an asset. Uh, if it's building, it's also an asset. So what we are saying in essence is that in any double entry bookkeeping, accounting equation defines the double entry transaction that an organization can have at any point in time. So like I was saying, what are the components of asset that I think we should be looking at? Cash itself is an asset. It can be a bank account. It's also an asset. It can be maybe furniture. You brought the furniture into the business. It's an asset. It can be motor vehicle. Motor vehicle. So all this brought into the business will be seen as capital on the other end. But they are much more. They have so many lists of assets. But for the purpose of this explanation, we will not go deep into it. So now let us go directly. Let's go further down to understand what the accounting equation is trying to tell us. Okay, in any business organization, let's assume the first scenario here paint a picture of just the business owner running the business and providing capital. Okay, let's go further down to say that okay, um the business owner has provided capital, but in running the business cannot in the, let me say, in the practical world, business cannot itself stand alone when you have only assets. There has to be other things to be able to back the assets, not only the capital that the business owner has brought into the business, maybe in the form of maybe borrowings. You understand? It can be the business owner can go to the bank to borrow some money, to some fund to bring to the business. When you borrow money to bring to the business, it becomes a liability. So what we're now saying is that the business owner is now using the business owner using the business model that it brought in, plus borrowing funds from the bank. So I just use this and this very simple example for us to be able to understand how we arrive at liability. So what we're now saying is that when the business owner goes to the bank to borrow some fund, that becomes a liability. So when you had both asset and liability together, the accounting equation is saying that that asset that the organization have is backed by two things. Number one is a capital that the business owner brought into the business, as well as the borrowed fund from the bank. It can also be in the form of maybe loans payable to maybe a friend. Can be maybe we purchase some items on credit that we are here to pay for. You understand? So every asset of the organization will be backed by capital plus liability. So that is what the accounting equation is trying to tell us. So let's now go down to understand what we mean by double entry bookkeeping. So there are certain rules of double entry that we need to understand. So what are these rules of double entry? Number one rule is that we will say that we debit the receiver and credit the giver. So what does this statement mean? When you say debit the receiver and credit the giver, it means that at every point in time in any business transaction, it's expected that you have somebody that is giving and somebody that is receiving, or a party that is receiving and a party that is giving. So let's say for instance the business owner approached the bank to borrow fund from the bank. So when the business owner borrow fund from the bank, then it means that let me say debt from the bank. This is $1 million. So this debt from the bank, who is the debt? Who is the receiver? Who is the giver? The receiver is the business owner, but the business owner will not write his own name. It will be the money the $1 million was received in the bank. So bank here. So let me say the receiver here is the bank. Yes, I mean bank account. Don't let me use the word bank because bank account is an asset for the organization. Then who is the giver? The giver is the bank that lent out the money, but we will not put it as bank here. We'll put it as liability or loan liability. So now we now say debit the receiver, which is debit, and credit the giver. So this is the rule one of double entry. So number two rule of double entry, we need to look at it the way we did the first one. The number two rule of double entry is debit value in and credit value out. What do we mean by debit value in and credit value out? When we receive value for certain things that's added to maybe cash or something, it means you have to debit the value that has come in as a result of cash in. But when you are paying out, let's say you pay cash out to somebody, maybe paid cash to suppliers of goods, so it means cash has gone out. So in that case, you debit cash when you receive cash. You understand? But when you pay cash out, you credit cash. So I don't think we need to dwell so much on that, so that will not waste so much time. So the third one of the rule of double entry is debit assets and credit liabilities. What do we mean by debit asset and credit liability? In this instance, if you look at it critically, we've been talking about the accounting equation here, where the business owner brought in some cash into the business. This is the first scenario I painted here. Yes, maybe the business owner has a bank account. This one is maybe when the business owner brought in furniture, and this one maybe when they brought in a motor vehicle. So in this instance, you will see that what we are saying is that if at any point in time you are bringing in an asset and it's increasing the value of the assets, for instance cash added, it means that you have to debit that asset. So anything that increases assets, you debit. Let me say anything that increases the value of the assets, and you credit anything that increases the value of the liability. So liability is the money owed to somebody, like the bank loan is a liability, maybe trade receivable is a liability. So when at any point in time loan increases, like you have, like this one for instance, the number one rule, you said because we got loan from the bank, that loan liability, you say that we have credited it. So it means that the value of the loan has increased, the value of the liability has increased. At that point in time you credit that value that increases the liability, but you debit the value that increases as the value of the assets. If the value of the asset has gone down, you need to credit it. If the value of the liability has gone down, then you need to debit it. So that's what we need to do, vice versa. So the fourth one of the rule is when you have expenses, um, expenses like maybe stationery, or maybe you paid for electricity, you debit expenses. Expenses maybe like electricity when you pay for it, maybe you pay for um, stationery, staff salary. These are common expenses that the business can incur at any point in time, and you credit income. Credit income in the sense that, income is, say for instance you sold some um, items, so that we can say that is sales, so it's part of income. So when you sell, it means that that value has gone out, but you have received a value in return, because when you sell you collect cash. It's either you collect cash or the money is being owed as a trade receivable. So you credit income like maybe sales. Other income area can be maybe income from finance income, like interest income. It can be insurance income, maybe insurance receivable, as a sort of maybe a claim receivable. So those are typical incomes that you need to look at. And the last but not the least, which is number five of the rule, is debit purchases and credit sales. So like we said earlier on, that with credit income, this is just like income, and you debit purchases because you have actually brought in value. So those are the five basic rules of double entry. So let's look at um, a typical example. Let me bring in a typical example and try to solve the question. So we have this example here. Um, this example started from, if you look at the example that we brought in, so let me put solution here. We said the following transaction relates to XYZ Enterprises for the month of January 2023. So in that month of January 2023, we say that on January 1, that is 1/1/2023, started a business with cash of $1 million and a building worth $10 million. So let's take it one step at a time. The first one is started a business with cash. So what do we need to do to complete our double entry? So we know that there's a cash account, and don't forget I said that when we start a business earlier on, I mentioned that the owner brought in capital. So when you say you start a business, what should come to mind is capital. So we have a cash account, then it means we have capital account. So now let's do like a T account for us to understand it properly. T account. T account. To make it easy for us, this is T account. So the first one is that we said started a business with cash of $1 million. So the first date is, what's the date? 1/1/23. Then you started a business with what? $1 million. It means you brought in cash of $1 million. But since you are bringing in cash, it means in the form of capital. So now you put here, okay, sorry, let me add something here. I have to add something here. Insert shift sales. No, sales rights. So here we have what we call capital, because capital was brought into the business. Here we have insert. Insert. So on the same date, 1/1/23, we have cash. How much is the cash? It's the same, 1 million. So what we're saying in essence is that every single transaction that you post must have a double entry. So the first one that we looked at, the $1 million, is the one that has the debit entry here. This is the debit side, and this is the credit side. So that's we need to understand in accounting. So the second part of the question says, and a building worth $10 million. So now we have a cash account. We already have a capital account here. Let me just copy and paste in the middle. Okay, we have a cash and capital account, but we don't have building account. So we need to create one. So I can copy this one and paste it down. So we can call this one building. And the capital account remains the same. So what we did there, like we did for capital for cash, we also do the same thing for building. So it's $10 million this time. While here, instead of having only cash, it's also what we call building here. So which is $10 million. So we have completed the first posting. So the next one is purchase furniture for $200,000. So here we purchase furniture for $200,000. So but they didn't tell us. Oh, they said okay, by cash. By cash. So when we purchase furniture, there has to be a furniture account, like we have this account here. So I have to copy this again to make life easy for myself. Yeah, copy. Yeah. So I'll call this one furniture. So in this furniture here, we have what's the date of the purchase of the furniture. Date is really important in accounting, so we need to, so it's 7th of January. So 7th of January, I'll change this one to 7th of January 7. But don't forget that we say that in the rule of double entry, let's go back to the rule so that we can understand. This is purchase furniture. We said debit assets and credit liability. So like I mentioned earlier on, when I was trying to explain what constitutes an asset, I mentioned furniture there. So furniture is an asset. So when you say you purchase furniture, it means it increases the value of an asset in furniture. So how do you purchase? You purchase through cash. How much is this? $200,000. But you paid cash because $200,000 was paid to buy the furniture. So look at the rule. I said debit value in and credit value out. So when you have a value out because you paid cash out, it means that that cash that you paid out, you need to show it that you have paid cash out to buy the furniture. So now what is the date? Is 07/1/23. Then what did you buy? You bought furniture. So then you put 200,000 credit. So if you look at it, what we've been saying since, we are trying to say that every single transaction that you post must have double entry. That is the rule that we're following. And if you see it, we'll be following the rule. So let's go ahead again. What's the next question? That happened on the 8th of January. Sold goods for the sum of 500,000 and received payment into bank. So there's a sales account, there's a bank account. So we need to always identify those two accounts. We sold goods, so it means there's a sales account sales account and what? Bank account. So let me call this one sales. What is the date of the sale? 8th of January. Then which account did we receive the money to? Into bank. So if you look at it, we have cash account separately, we have bank account separately. So that is 8th of January. So the rule says that we debit debit expenses and credit income, and our sales here is an income, so it means we have to credit the sales account. So 8/1/23. So what did we say? How did we receive money for the sales? It's through the bank. How much is it? I think it's with, is it 250,000? No, 500,000. Yeah. So that we need to always check. 500,000. So since we are selling, it means we are receiving the same thing here. So here is 8/1/23. What did you do? We sold, which is sales of how much did we receive into the bank account. So because the bank account has increased, so we need to debit it. So the next one of the question is transfer cash of, on the 15th of January 2023, we transfer cash of 250,000 into bank. So what we're saying is that out of this cash that we have, though we have bought furniture, but we also transferred something out. So you debit value in and credit value out. So don't forget, now is the value out of cash 123. Where did we send it to? We send it to bank. How much is it? 250,000. 250,000. So the next one is to now do the entry. Where did the money go to? 250,000 into this account. Where did it come from? And the date is 15th January 23. It came from cash. So you debit value in. And now we need to look at the next question. The next question is let's look at it. I think it's on 22nd of January. Yeah. Sold goods on credit to ABC Limited for the sum of 180,000. So this is another dimension to it. With the company sold goods on credit to ABC. So now we have sales account and we have ABC Limited. So now let me copy it down. ABC Limited. So we said we sold goods on credit. Don't forget, when you sell goods, is credit sales. Who did you sell it to? ABC Limited. Look at the difference between what we did before and this one. The first one, we said we sold goods and payment was made into bank. Because we received the money to bank, that's why I put bank here. And here, because we haven't received the money, it means there's a trade receivable. Who is the debtor to us? ABC Limited. That's why I put in the name of ABC Limited here. And the value of the sale is 180,000. 180,000, yeah. So how much is the sale here? 22,123. So sales 180,000. That is ABC Limited. The last but not the least is purchase goods worth $200,000 on credit from Access Limited. So we now purchase again. So there's a purchase account instead of having a sales account. There is a purchase account that we also need to recognize. So there's a purchases account. And there's what is the name of the company? Yeah, Access Limited. Access Limited. So we purchase on the 27th of January from Access Limited. Goods worth $200,000. Yeah, 200,000. So Access Limited. Then on other Access Limited, to be on credit side, that is the liability 27/1/2023. And what is this? Purchases. So what we are saying in essence is that for every entry, every transaction in a book of account, there's always a double entry, and this is how the double entry for each account will be done. So on balancing this account, you'll be watching this from a separate video to understand how we balance our account and prepare what we call a trial balance. So but for the purpose of this, just to understand how double entry transaction works. Thank you. God bless you. Bye.